Hello, everyone, and welcome back to the weekly Tanker Market podcast. I'm Trisha, your host, and today we are diving deep into the often murky waters of the tanker market. Freight rates, geopolitical tensions, and the whispers of super cycles. It can all feel a bit overwhelming. Therefore, to help us navigate, I'm thrilled to welcome Sandesh Ghandat, a seasoned expert in shipping market analysis. Sandesh, welcome to the show.
Well, thank you, Trisha, for introducing me. It's always a pleasure to share my knowledge and expertise with our audience. Thank you for inviting me once again.
So here's a burning question for you that everyone's been asking. Are we really seeing a tanker market rebound or is it just a flash in the pan?
Thanks, Trisha. Great to be here. And that's the $1,000,000 question, isn't it? The short answer is it's complicated. We are seeing some positive movement, but sustainability is the key issue.
Well, we are sure to talk about it as we move ahead in the podcast. Now, let's start with the crude tankers. We have seen some wild swings in VLCC, Suezmax, and the Aframax rates. So, what's driving this volatility and what signals are you watching?
Well, Trisha, absolutely. The VLCC segment, for the example, had a kind of a bit a roller coaster ride last week. Early on, increased vessel availability and focus on the mid-March loadings. We do have a steams available and it puts charters in a good position. Now, talking about the specific or regional specific analysis, ex-MEG East Straits, that is Middle East Gulf to, Far East rates. So it seems to be find a floor around world scale 58. But even though there were a lack of fresh inquiries later in the week and it did not fall further. And we have a XWAP, that is West Africa market. They saw a similar pattern where market remained subdued at the start with the rates edging lower and owners, they kind of struggle to maintain rate levels amid a surplus of early open tonnage. And ex-USG, that is US Gulf, it was inactive compared to AF and, Middle East Gulf area. But that has a similar effect on the rates and the rates gradually declined over the week. Now, on the Suezmax front, things were a bit more optimistic, especially out of West Africa. Remember that surge in inquiries after International Energy Week? That gives the rate a noticeable boost. With the TD6, it increased by 1.87%. And then we have a TD20, another benchmark route. It increased by 33.9% week on week. But the Aframax segment, it was pretty quiet with the minimal fresh inquiries and, it keeping rates subdued. But with the relatively tight vessel supply, declines were kind of limited. So having said that, what is the key takeaway if you ask me? We are seeing the rates fluctuating, but at the same time, we should focus on demand increase, which could change everything in the coming weeks.
That's quite interesting. I mean, it does sound like a mixed bag across all the crude segments. Now, you mentioned about the International Energy Week bump. So, I would like to ask you a question about that. How much do these kinds of events, really impact the market? And is it usually a short-term blip or a longer trend setter?
Well, these kind of events like International Energy Week and even the others, they kind of act as a catalyst because they generates a flurry of activity, conversations, and ultimately cargo bookings. So usually you see an immediate rate spike or a shot in the arm, if you will. The real question is whether that spike translate into sustained momentum. In this case, the Suezmax market out of West Africa saw some genuine traction that we have witnessed, and we hope that it will kind of reflect into coming weeks.
Well, Sandesh, what about the Indian PSUs? How did it impact there? Is there anything that you'd like to add?
Well, Indian PSU, they were quite active and they have definitely role to play. They have quoted one VLCC around last week, and with the last one, that is ex-MEG West Coast India, it covered at world scale 69. And then on the Suezmax segment, Indian PSUs, they kind of it was a massive market for them. Sentiments were very, very high. They quoted around 5 cargoes last week, and the last one, XMG West Coast India, it covered around world scale 104. So the demand is increasing in Indian PSUs as well. It means that market is kind of going to flourish in the upcoming days.
That was an excellent overview on the crude segment, Sandesh. Now, let's shift gears a bit to the CPP tankers. What do you think are the key trends that you're observing in the LR and the MR segments here?
So, Trisha, that was a good question. Here we see a kind of a divergence because in the LR segment, LR2s they kind of seem to be outperforming LR1s. So the east of Suez LR2 market is kind of holding steady for the week, and it repeating at world scale 130 for AG Japan NAFTA shipments. So even with the assurance from the Houthis owners, they are still wary of the Red Sea and it favoring the Cape route. So it is impacting the market a lot. Now, in the MR segment, on the other hand, is kind of facing some downward pressure because TC 1235 ex Sikka to Japan route is kind of a very down right now, and as is similarly, we have TC 1775K ex AG to East Africa route. It is also significantly down. And what's interesting is that even though the rates are softening, earnings on the latter route are actually up. So this is kind of a something new that we are seeing. But yes, we have seen some kind of movements in the past where your world scale rates are declining, but earnings are kind of increasing. Having said that, this could indicate efficiency in the vessel utilization or other cost saving measures.
Now, Sandesh, speaking about the geopolitical risks, the Houthi situation in the Red Sea has been going on for months now. So, could you tell us how are ship owners actually adapting to this? And, what are the long-term implications for trade routes and the freight costs?
Well, the this Red Sea issue is kind of going on for some months now, and the Red Sea situation is a game changer. Owners they are adding a war risk premiums to their rates, and many are diverting vessels around the Cape of Good Hope. This adds significant time and cost to the voyages. While the Houthis they have given their assurance 3 4 weeks back, and it's kind of a nice theory, but in practical the risk is still too high for many, and that is why these ship owners they are kind of looking for wait and watch approach until the everything settles down. However, if this situation or Houthi assurance it did not work and the risk it continued to persist, we could see a permanent shift in trade routes. With the Cape routes, they become the new normal for east-west trade, and it is what could change everything in this, and it can have significant impact on the product tankers specifically.
You're absolutely right, Sandesh. That is definitely something to look out for. Now, since we are talking about the CPP segment, could you tell us more about India's perspective on refining sectors?
Great question, Trisha. I am feeling very proud to saying that India's refining sector is undergoing a transformative shift, and with the expansion and capacity upgrades, it kind of a redefining throughout dynamics. And with the GDP increase and with the industrial production increase, it's kind of a necessity to increase this transformation shift. We have a BPCL's Kochi and Mumbai refineries are poised for major 2026 turnarounds, ensuring a long-term reliability. The expansion it kind of a drives, intensifies as IOC also eyes on 25% capacity boost to 1.75 million barrels per day by 2029 2030, and it kind of a reinforcing its refining backbone. Then we have a NRL's polypropylene unit for 2027-2028 upgrade, and it will elevate its petrochemical footprint while we have a HPCL Mumbai refinery bets on $500 million base oil project can hike LOBS production by 61% to 765,000 metric ton per year by specifically 2028. Then we have a Vizag refinery. It is also commissioning 3.5 million metric ton per year RUF unit, and leveraging first of its kind LC Max tech sets the stage for heavier crude processing with capacity debottlenecking in the pipeline. So these are just kind of examples that how refining sector is growing. Then we are also expecting some greenfield implementation in the refineries. We have Ratnagiri refinery, then we have BPCL. They were kind of eyeing new refinery in Andhra. So overall, we can say that with India's refining juggernaut firing on all cylinders, market players will keep a close watch on product balance and the freight flows as these shifting crude slates and expansion timelines reshapes regional trade patterns. So the aggressive expansion of India's refining capacity alongside sustained high utilization rates it kind of signals a bullish long-term outlook for MR product tanker market. Then with IOC, BPCL, HPCL, and even MRPL, they kind of adding refining capacity and upgrading secondary processing units. And product export from India are poised to rise, that is for sure. These are particularly for gasoline, diesel, and petrochemicals. And now you wonder where this excess product or this product will travel to. So IOCL's and MRPL's efforts, it will significantly boost clean product flows into the key demand hubs, like East Africa, Southeast Asia, and Europe. So that was the key market for them to, kind of increase their export and be a sustainable exporter in the coming years when they, kind of finalize their expansion and new refinery implementation plans. And they can continue their market share and even have that product balance where they can increase the market share from the current state. So this is kind of a overall from my perspective, Trisha.
Definitely an amazing overview that you gave on the CPP segment, Sandesh. Now, finally, let's touch on LPG tankers. So, could you tell us what's the story here?
Well, the LPG market is in a bit of kind of a holding pattern. We have East of Suez market. It was kind of a muted with the limited activity. And then the freight rates, they have aged up slightly for the Rajasthan Chiba route, which is a benchmark route for, LPG transport. So with the IOC securing $51 per metric ton Baltic equivalent rate for in March, we can say that market is somewhat muted because we have seen those particular rates on a very high side in the past. Similarly, the West of Suez market is also quiet with a few mid-April USG deals reported and vessel supply kind of fragmented at the time, and it could lead to some volatility in the near term.
So, are there any specific trade lanes or, let's say, regions that are, particularly active or under pressure right now?
Well, the US to Asia LPG trade lane is one to watch, and we have to watch this because you know what, US production continues to rise, and we are seeing more and more LPG being shipped to meet growing demand in Asia. We have seen Chinese demand is increasing because the PDH plant is increasing, the utilization rates are increasing. Then we have a Panama Canal was kind of and is kind of a key choke point right now, and on this route, any disruption there could have a significant impact on the freight rates.
Well, Sandesh, I have to say it has been truly incredible and insightful discussion that we had today. Thank you so much for sharing your expertise, and it was great to have you here.
Well, thanks Trisha, and thanks to audience for supporting us over the time. It was a pleasure for me to be here and share my knowledge with you and our audience. Thank you, Trisha.
Thank you so much, Sandesh. And to all our listeners, thank you so much for tuning in. Do not forget to share and follow us. Until next time, navigate safely and stay informed.